Welcome to Under the Basswood Tree with Basswood Counsel, a podcast where we bring you brief, valuable conversations and insights to help you navigate the complex world of business transactions. From cross-border deals to international tax structuring, we cover topics across all industries. Our team and colleagues will share their insights and provide practical tips on key issues for you and your business. Let's get started.
Hello, everyone. Thank you for joining us for this podcast. We're going to be talking about the One Big Beautiful Bill Act that was recently passed. I'm Chris Klug of Basswood Counsel. With me, we have Gina Lee and Renee Tiun, both of Basswood Counsel as well. We're going to focus on the individual tax provisions for this podcast. This is one of President Trump's landmark legislations for his new term, and this and I guess tariffs. So depending on how you think of policy, but what's very important is that people understand what's in the bill as it relates to them. And so we're going to be walking through the individual tax provisions, hopefully so you better understand, but it's important where you can get tax benefits from this bill. One of the initial things from the 2017 Tax Cuts and Jobs Act, the tax rates were going to increase at the end of this year to what they were prior to the enactment of, and I'm going to refer to the One Big Beautiful Bill Act as the act. It's just very long. So, Gina, what's going on with the income tax rates?
Yep. So under the act, I was going to refer to it as the OBBBA. But under the act, the individual income tax rates are going to stay at the current rates, with the top tax bracket at 37% instead of reverting back to 39.6%. And the marriage penalty relief for most tax brackets will continue. What that means is for married couples filing jointly, they will typically not face higher taxes compared to the single filers.
So you mean prior to this, you were penalized for being married under the tax code?
Well, not necessarily. I
don't really like marriage. No, I'm joking.
Yeah, hopefully he's joking. So if you were filing single, your tax rates would have been, X, let's say 20%. And if you were to file jointly, you didn't want to be paying taxes, 2 times for the single filers. Instead, there was some tax benefits for filing jointly as a married couple. So the act will continue to make sure that the married couples don't get penalized for filing jointly.
Okay. And for avoidance of doubt, and so I don't get in trouble later, I'm a happily married person. That was a joke.
Yes.
One other aspect of the act is the increase to standard deduction. Can you explain that, Gina?
Yep. So I will talk about a couple of items under the standard deduction. So the standard deduction has been permanently increased and enhanced for 2025 and beyond. So for 2025, for joint filers, they will get $30,000 for standard deduction, head of household $22,500, and $15,000 for single filers. And this will be applicable for current year 2025, and there will be further increases in the coming years. And because of the higher standard deduction, fewer taxpayers will benefit from itemizing deductions. So taxpayers may want to consider bunching itemized deductions for 1 year and then take the standard deduction the following year, and then vice versa for alternate years. And in addition, for tax years 2025 and 2020 through 2028, individuals aged 65 and older, I will refer to them as senior taxpayers, they can claim a new additional $6,000 deduction per qualified person. So this is in addition to the $1,500 additional deduction that are allowed for senior taxpayers. To maximize this benefit, seniors should also try to keep their adjusted gross income below a certain level, which is $75,000 for single and $150,000 for married joint filers. And they have to make sure that they include the correct Social Security number to qualify for the additional tax credit. And I can just continue on to itemized deductions, because that can be a big part of deduction for other taxpayers. So the OBBBA or the Act permanently repeals the prior piece itemized deduction limitation and replaces it with a simpler rule. So under the prior piece provision, which was suspended actually under the Tax Cuts and Jobs Act, high-income taxpayers could see their itemized deductions reduced by as much as 3% income above certain thresholds. And under the Tax Cuts and Jobs Act, high-income taxpayers actually could claim full itemized deductions without the piece limitation. Now, after 2025, the piece limitation was going to come back, but under the Act, OBBBA, starting in 2026, the piece limitation is permanently repealed, and instead it imposes a smaller reduction, which is 2/3/7 of the lesser of total itemized deductions, or the amount of taxable income over the 37% tax bracket. So with this change, again, bunching deductible expenses into one single year could be more beneficial for certain taxpayers. And in addition, a lot of the miscellaneous itemized deductions, which were suspended during the Tax Cuts and Jobs Act, are permanently repealed. So some of the miscellaneous itemized deductions are investment expenses, tax preparation fees, and certain unreimbursed employee expenses. These are going to be permanently not available except for educators. So
To be clear, we're not in favor of not being able to deduct tax preparation fees.
yeah, so true. Yeah, so just a little bit about the educator expenses, which will be allowed. They refer to unreimbursed costs incurred by teachers, instructors, counselors, and aides for classroom supplies, professional development, and other job-related items. So for 2025, these qualifying educators will still be able to claim an above-the-line deduction up to $300. However, beginning in 2026, the deduction will become an itemized deduction on Schedule A, meaning the $300 cap is removed. In addition, the $300 cap is removed, but since the deduction will be now only be available to those who itemize, some educators who claim the standard deduction will no longer be eligible to deduct these expenses. So again, these educators should think about bunching their expenses into 1 year so that they can take full advantage of the deduction and be able to itemize in 1 year and then take the standard deduction in the next year.
And just quickly to take a step back, standard deductions, everyone can take the standard deduction. You don't have to have expenses that equal the threshold amounts. You only itemize on your tax return, or you should only itemize on your tax return, if your itemized deductions exceed your standard deduction. So for lower income people who don't have high itemized deductions, this higher standard deduction rate is very beneficial. Gina Lee, moving on to the alternative minimum tax exemption amount, can you kind of explain what the alternative minimum tax is just quickly? And then what's going on with the exemption amount?
So alternative minimum tax usually applies to higher taxpayers. So what it does is for a typical taxpayer, they get a lot of deductions like the itemized deductions that we just talked about, in addition to other credits. For purpose of calculating the alternative minimum tax, we remove a lot of the deductions that were allowed to calculate the regular tax. For higher taxpayers, AMT, which is the alternative minimum tax, is supposed to impose an additional tax by removing all of the deductions and then calculating the AMT. And if there is any difference between the regular tax and the alternative minimum tax, they will be subject to that excess additional tax, which can be a penalty for certain higher wage earners. You should be careful to consider how it's calculated and how it's going to impact you as a taxpayer. Now, under the Act, the AMT exemption amount are permanently increased for 2026 and beyond, but the phase-out rate for higher income taxpayers doubles from 25% to 50%. So, like I said, the taxpayer should review their AMT exposure and consider strategies such as timing income or exercising options in lower income tax years to avoid unexpected alternative minimum tax liability.
Okay. Thank you for that. And then what about moving expenses? What's the new rule on moving expenses?
Yep. So as previously mentioned, moving expenses were one of the unreimbursed employee expenses, and they were non-deductible under the Tax Cuts and Jobs Act. Now, under the One Big Beautiful Act, the moving expenses are going to be permanently non-deductible for most taxpayers, and except for the military, active duty military members moving under orders. And also, starting in 2026, certain intelligence community employees remain eligible to deduct or exclude qualified moving expenses.
Okay. Yeah. So, they are moving people in federal agencies all around. So I guess they zeroed in on the intelligence community and they still get the deduction. Very good. What about disaster-related personal casualty losses?
If you suffered a loss due to a federally declared disaster, you can now claim a personal casualty loss deduction, even if you do not itemize deductions. Before the act, you had to claim itemized deductions in order to deduct the losses. However, starting 2026, the standard deduction will be increased by the amount of the net disaster loss. So you should really document your losses and insurance claims, and consider filing an amended return if you missed an opportunity to claim the qualified loss in a prior year. In addition to that, starting in 2026, the personal casualty loss deductions are permanently limited to losses from the federally declared disasters and certain state-declared disasters. So just keep in mind that you need to really qualify under the federal law.
Okay. Well, thank you for that. Renee, the child tax credit is very important to a lot of families in the U.S. What's the status of the child tax credit?
Well, thanks, Chris. Well, we have good news for families with children because under the child tax credit, under the Act, it has been permanently increased from previously $2,000 to $2,200 per qualifying child for tax years after 2024. And it will be next for inflation in the future years. So refundable portions, which is different from the typical child tax credit, would be increased from $1,700 from $1,400. So good news to families all around with children. However, it's to be kept in mind that you have to have a correct SSN on the tax return for a child to be qualified as a dependent. Otherwise, the IRS can summarily assess, which means they can deny credit or send a math error notice with 60 days to respond.
Yeah, and so with the child tax credit, that's a deduction against income. But if your tax is zero, there's a refundable part of it, and so the additional child tax credit, which is that $1,400 amount that Renee was referring to, which is now $1,700, you can actually get a refund if you have enough of it left over. And so for our clients, a lot of them who live outside the U.S., they're U.S. citizens, but a lot of times they're in higher taxing jurisdictions. And so once they get credited for the taxes paid in that jurisdiction, they don't actually owe any U.S. tax. And even though they paid no U.S. tax, this additional child tax credit gives them $1,700 per child, subject to the limitations. So that's very important. What about child and dependent care credit?
Yeah, thank you, Chris, for the clarification. So on child and dependent care credit, again, good news. The maximum credit rate increases to 50%, previously 35% of eligible expenses, up to $3,000 for one qualifying individual or $6,000 for two or more. So the $3,000 and the $6,000 remains the same under the TCJA and is brought forward with the Act. So the full 50% rate applies to families with AGI up to $15,000 and gradually phases down to 35% for AGI up to $75,000. So to maximize your benefit, make sure to keep thorough records of all qualifying expenses and coordinate with your employer provided dependent care benefits to avoid missing out on any of this credit potential.
So they're trying to encourage people to work? Yeah, it's crazy.
I would like to say they would like to create more opportunities for people to go out and improve, work on their careers and have a family at the same time.
So what's this thing called the Trump account?
Well, this is a very new thing under the Act. It's a account where taxpayers can open a new tax-deferred investment account for children, and it's called a Trump account for each eligible child. So taxpayers can contribute up to $5,000 after tax dollars for each child, and funds must be invested in a diversified U.S. equity index fund. However, the additional perk to it is for children born between January 2025 to December 2028, the federal government will automatically contribute up to $1,000 each account.
Is that the federal government or is that Trump?
Well, I think they are both one and the same.
Okay. Well, moving on, I'll talk a little bit too. So the adoption credit. So if you adopt a child, you can get a credit against your taxes for the amount you paid up to a certain extent. So starting in 2025, the adoption credit is $5,000 and it's refundable. So families with less money, they can get a refund on their taxes through this adoption tax credit. With everything else in tax, you need to keep good records, have everything well documented, and you got to file the proper form. Moving on to what we call ABLE accounts. ABLE accounts stand for Achieve Better Life Experience. The purpose of an ABLE account, just to start off, and I think these were passed under the 2017 Tax Cuts and Jobs Act as well, is that people with disabilities who are on mean tested programs like Medicaid, they can only have very low level of assets such as cash. And so the ABLE account is a special account that they can have where they can have cash in there and won't be counted against their eligibility requirements. Under the Act, it permanently allows beneficiaries who make qualified contributions to qualify for the Savers Credit. It increases the amount you can contribute per year to $2,100 under the credit. And so this is another big benefit for families with a child or someone living and working with a disability. Now there's a new deduction for car loan interest. And this deduction is if you buy a new U.S. automobile, so there's a definition of how much has to be made in the U.S., you can now deduct for tax years 2025 through 2028 up to $10,000 per year of the interest. And it's subject to some limitations. So there's a phase down for individuals if their modified adjusted gross income's over $100,000, and for joint filers if their income's over $200,000. $10,000 is quite a lot of interest to pay in 1 year on a car. So I don't, but regardless of whether the deduction is $1,000 or $10,000, it's a benefit. Renee, what's the status of deductions for qualified residence interests?
Well, on that note, the deduction for mortgage interest on home acquisition debt is now permanently capped at $750,000. So if you're married filing separately, as previously when Gina mentioned, it is capped to $375,000. And rather than increasing to $1 million in 2026 as previously scheduled. So if you're considering buying a home, refinancing, or taking out a new mortgage, be aware of the interest debt above $750,000. There is also a new deduction. So for qualified home mortgage insurance, it is also now deductible for taxpayers who have AGI below $100,000 per year, and it is phased out. So additional perks if you bought a new home in the U.S.
Okay, well, thank you for that. And some bad news for my gambling friends. Starting in 2026, there's a limit of how much losses you can deduct against your earnings in gambling. So going forward, only 90% of the losses you incur in gambling can offset your earnings. And so it's possible that you could have negative overall earnings, let's say, or losses. Let's say you have 105 in losses and 100 in earnings from gambling. Even though you have $5 more in loss, you can end up paying tax because you got to reduce that $105 by 90%. And Renee, what are the new rules on individuals for charitable deductions?
Well, beginning in 2026, the Act makes the permanent 60% ceiling for cash gifts to 50% charities. And it provides that a contribution of cash to a 50% charity is deductible to the extent that the total amount of contributions of cash to 50% charities does not exceed the excess of 60% of the taxpayer's contribution base for the year over the total amount of contribution to 50% charities for the tax year. So to maximize deduction, taxpayers should prioritize cash donation to 50% charities. Also, if taxpayers who don't itemize, they can deduct up to $1,000 for certain charitable donations, and the cash it has to be via cash donations to qualified charities. And of course, this number doubles to $2,000 for persons filing married filing jointly.
Okay. And, for health insurance, the Affordable Care Act passed by President Obama has been a big impact, in the health insurance industry. And so starting in 2027, there are new rules for claiming the premium tax credit, which helps lower income individuals to pay for health insurance. Now you don't get the premium tax credit unless the qualified insurance exchange has verified that you're entitled to it in advance. And so in order to avoid losing your credit, make sure you timely file your tax returns, and that you have your information in order, because you wouldn't want to lose that benefit or have any kind of issues with it. There's something called scholarship granting organizations, and you get a special deduction if you contribute to one of these. So this is new for tax years ending after December 31st, 2026. So there's a little pause on this one. Individuals can claim a federal income tax credit up to $1,700 per year for cash contributions to a qualified granting organization. So obviously it's an organization that's going to fund scholarships. So this is a new benefit that will come. Renee, what's the change with the American Opportunity and Lifetime Learning Credit?
So most of the benefits under the American Opportunity and Lifetime Learning Credits remain the same, with the sole exception that the student or yourself or your spouse have to have a valid Social Security number. So previously, only a TIN is sufficient, but as of 2026, you have to, the claimant has to have a Social Security number.
Okay. Thank you for that. All right, and then there's been some changes to the 529 plans. So now families using 529 plans to pay expenses for people in kindergarten through 12th, there's broader categories of expenses that qualify. So, and it's not just tuition anymore, but they can also deduct curriculum, books, online marketing, online materials, tutoring, standardized test fees, dual enrollment, and educational therapies for students with disabilities. So starting in 2026, the amount that can be used each year doubles. So it's not limited to $10,000 per year. It's going to increase to $20,000. You can get out of the 529 plans. So it's important to understand this to maximize your planning. Another change to the 529 plans is they will cover wider educational expenses, including post-secondary credentialing expenses, and various other equipment and supplies. So it's important to understand, if you have a 529 plan, what you can use the funds on. Gina, what's going on with the estate and gift tax?
Sure. So under the Tax Cuts and Jobs Act, we currently have almost $14 million per individual for estate and gift tax exemption, and $14 million for generation skipping transfer tax exemption amount, which was supposed to set and decrease to about $7 million per individual after 2025. Effective January 1st of 2026, which is next year, the exemption amount is permanently increased to $15 million per individual, and will be indexed for inflation going forward. So we recommend reviewing and updating your estate plans and consider making larger lifetime gifts to take advantage of the higher exclusion amounts.
Okay. And Renee, what's this about remittance transfers?
So this is a new provision on the Act as well, something that I or anyone who has families outside of the U.S. might be affected. So starting in 2026, a new 1% excise tax will apply to remittance transfers from U.S. senders to recipient in foreign countries. So transfers funded with cash through non-U.S. payment apps like cashier's checks, MoneyGram, MoneyWise may be subject to tax. So make sure you plan ahead and make use of the exempt methods like using a financial institution governed by Title I of Chapter 52 or funded with a U.S.-issued debit or credit card to minimize your tax liability. So this provision is effective for transfers made December 31st, 2025 onwards. So please do review your remittance methods to take advantage of the exemptions and make sure you are not unnecessarily hit by this tax.
Okay. And one other big change in the act is the revival of something that came from Trump's initial term under the 2017 Tax Cuts and Jobs Act is the Qualified Opportunity Zone. So that's the benefits under that are now permanent. They changed the rules a little bit. And so what a Qualified Opportunity Zone is, it gives an individual lots of benefits. First, if you sell something that creates capital gain, it allows deferral of the gain recognition until some point in the future. If you hold it long enough, it allows a haircut, a reduction of the amount realized. And then the growth of the investment is tax-free if you hold it for 10 years. So lots of benefits for Qualified Opportunity Zone. So this gives a additional incentive for usually higher earning individuals who sell and have a big capital gain recognition to be able to put the funds somewhere else. There's also the opportunity to deduct up to $10,000 against ordinary income in your Opportunity Zone investments. So there's some exciting times for individuals with investing, and kind of reused the old provision that was about, kind of fading away with its benefits. With that covers our podcast under the Act. This is, focused on the individual benefits. On behalf of Gina, Renee, and I, we thank you for listening.
We hope you enjoyed this episode. To stay up to date with the latest legal insights and Basswood events, please follow us on our Basswood Counsel LinkedIn page and visit our website at www.basswoodcounsel.com. Thanks for tuning in, and we'll speak to you next time.